the Chief Economic Advisor, Krishnamurthy Subramanian, and I just want to check if she's already live and if we could go across to her and listen in to that exclusive interview. Ruchi?
Secondly, the NBFC is also filled in to sort of take the gap that was created by the by banks not having the ability to lend. Now, there are two aspects actually that we need to remember, think about. One on the, debt mutual funds, and second on the NBFCs. First, if you look at on the debt mutual funds, unlike the banks, which actually specialize in sort of evaluating firms, their credit, mutual funds really do not have as much expertise. So this was something that was actually a sort of maybe the need of the hour, but expertise does not get built overnight, and therefore while money went in, their ability to evaluate some of those credits, screen and actually possibly monitor borrowers, clearly the comparative advantage lay with the banks, and this was something that the mutual funds were doing fresh. Second, on the NBFC sector, which is also related, so people are, for instance, talking about actually the fact that there is liquidity, there's liquidity crunch. But I think, if you sort of dig a little deeper, the key issue is that you have actually had an asset-liability mismatch where the NBFCs are lending a lot more long-term and they're taking short-run loans and they're rolling it over. Now, what actually appears as a liquidity crunch is actually related to solvency, because when you're, when things, particularly in the sector itself, start looking not that sanguine, then the investors, sort of are a little reluctant to roll over the liability. So what actually appears like a liquidity issue is actually related to solvency. It's the solvency that is feeding into the liquidity aspect. And related, another important, which actually something that we need to think about, as a policy, aspect going forward, is that so for instance, if you are a firm that is listed and you suppose have a corporate bond issue, then if you default on that, you have to reveal that to the to the regulator, to the market participants. If you look at the in terms of the credit space itself, about 85% is basically bank loans. But here even if a corporate, let's say, defaults, actually there is no, as yet there isn't some mandatory disclosure. And to give you a and because this is really critical, what happens as a result is, if there is continuous flow of information, if you suppose have not repaid, let's say, then investors actually, so the prices incorporate actually information that is coming in. But when you do not share that information, and then eventually when then a default happens, then there is basically a huge shock. So what is critical, and here's where I think what is also important for us to remember, if you look at a lot of the advanced economies and even some of the BRICS economies, right? If you default even on a covenant, if you basically violate a covenant to the loan, that is also a material disclosure that has to be given. So to summarize what I'm saying, I think we need to be really thinking about the asset liability mismatch. We also need to be thinking about actually ensuring disclosure. For instance, maybe a 1 day is actually too soon, 7 days for instance, but these are steps that we'll have to take to avoid a recurrence of this problem. As of now, and we basically having, after the ILFS crisis, the firewalling has been done, and that is actually has limited the problem.
Is the government looking at it more actively? And I also have to ask you, how deep really is the rot? Because a lot of important voices from corporate India say that over the next 6 months there will have to be a lot of firefighting that the government will have to do. Once the new government comes in, their hands are going to be full with respect to what's happening in the entire financial sector.
So again, let me lay out sort of the principles for how we should be thinking about this. There are some sort of assets or some firms that are in distress, and the government is certainly seized of the matter. My sort of humble submission here would be that in thinking about the steps, we have to be very careful in ensuring that first we don't have a situation of private profits and socialized losses, and also think about this in a dynamic sense, because if you intervene today, it actually can create moral hazard for tomorrow. Now remember, investors that actually have invested in the mutual funds have been aware of the risks, and they, on the positive side, when the risk has been, let's say, has been beneficial to them, they have enjoyed the returns. Now the flip side therefore is when things don't work out, that is actually how a market works.
The flip side,
unless there is a systemic aspect or a contagion aspect, I think it is you have to be very careful not to sort of further private profits and socialized losses, whether it's at the investor level or at the corporate level.
The flip side is also the fact that a lot of these mutual funds cannot act like banks. Do you believe there is some bit of a regulatory oversight there which should have come in at a...
So see, again, you have to be now, I think you have to look at both sides of the trade-off here. That while, let's say mutual funds cannot go and take deposits, for instance, but they also have, the regulation is, they're not subjected to the CRR, SLR requirements, etc. And that's the trade-off that mutual funds have chosen to actually to be mutual funds, debt mutual funds, and not be banks. And now when things basically go south, to say only focus on the costs and not the benefits that they enjoy, I think is an asymmetric evaluation which we should avoid.
But why are we seeing this entire mutual fund space, the debt mutual fund space, the NBFC space bursting in phases? We have seen what happened with Ireland FS crisis. We have seen the entire DHFL fiasco and the SL Infra case. One after the other. Are we staring at NBFC crisis 2.0?
No, I think, as I've already highlighted, actually, what I've highlighted the conceptual issues that we need to fix to ensure. Number one, as I said, I think is, if you do not disclose information regularly, then investors actually, in a market, investors price it, and through prices, then, all the stakeholders actually, take into account how their behavior must change. So disclosure of information is really critical, number one. Number two, actually, what we've had is, as I already said, mutual funds actually, while they moved in, they did not have the expertise, and that is something, so you have to there are some amount of irrational exuberance here without thinking about whether you have the ability to evaluate the credit. And that's the second aspect that has to be remembered. And third actually is in the entire NBFC space, the asset liability mismatch. Because if you look at the characteristics of any, whenever there's a problem in a financial sector, one of the key themes that emerges actually is that, firms that sort of go into distress are those that ended up lending a lot more long-term and had short-term liabilities. And these are some of the...
All right, we'll continue to bring you excerpts of that interview.